Hey guys, welcome back to the F Word. Today I want to talk about something that's been on my mind lately, the gap between building a successful business and building the right business. When I started Stash Wealth, I kept hearing the same advice from people in the industry. Grow fast, scale bigger, make it easier for people to say yes, just remove the friction, automate everything. And I get it. That advice works. It's how you build a valuable company quickly. Now, whether or not it's lasting is another story. Here's the thing I keep coming back to. The fastest path to growth and the best path for clients aren't always the same path. In fact, sometimes they're the complete opposite. So I've made a series of decisions that probably has slowed us down, decisions that has made us less scalable, harder to sell, but every single one of them was made with the same question in mind. What do our clients actually need from us, not what's easiest to sell them? Because the way financial advice is structured has a bigger impact on your outcomes than almost any single investment choice. So today, I want to talk you through some of the decisions that I've made, not because I think we're special or because I want a pat on the back, although I'll take one, but because I think it matters that you understand how financial advice actually works, and more importantly, how the incentives in the financial services industry can work against you if you're not paying attention. This is not an ad for Stash Wealth. I hope it paints a picture for why I took this route with the way I'm building my company, and hopefully inspires others looking to serve next-gen wealth to do so in a decent way. Let's get into it.
Who the f*** am I to tell you what to do with your money?
My name is Priya Malani, currently managing millions of hardworking dollars. Enough foreplay. Let's talk
Money.
Welcome to the F Word. Smart money.
No bull.
Decision number 1, you're worth investing in right now, not someday. Let me start with the most foundational decision I've made because it shapes basically everything else. Most financial advisors look at a 31-year-old with $50,000 and think, yeah, come back when you have real money. They'll point you to a robo-advisor or some app. They'll tell you that you can't afford real financial advice yet. They might even tell you you don't need it. That hand-holding and personalized service is for people with really serious assets. Well, we look at that same person and say, this is exactly when you need us most. Because the decisions you make in your 30s, with your first $50,000, matter way more than the decisions you make in your 50s with $500,000. The habits you build now, the foundation you lay now, the education you get now, that's what compounds. But the industry has decided you're not profitable enough yet to deserve that kind of attention. They've done the math. It doesn't make sense to give you high-touch service when your account balance is small. I made a different choice. We choose to invest in you before you're profitable by traditional standards. We give you the same level of service, the hand-holding, the education, the access to your advisor that most firms reserve for their million-dollar clients. Is that ridiculous from a business perspective? Debatable. Does it slow our growth? Probably. But we're not building a firm that extracts maximum value from people who already have wealth. We're building relationships with people at the exact moment they need the guidance the most. And we're betting that if we serve you well now, we'll grow together. Okay, decision number 2. Your advisor will never try to keep you from your money. This is a big one, and it's going to require me to pull back the curtain a bit on how most financial advisors get paid. In our industry, the standard model is this. Advisors get paid a percentage of the assets they manage for you. That's it. It's called AUM, assets under management. So if you have $100,000 invested with an advisor and they charge 1%, they'll make $1,000 a year from your relationship. Now, here's where it gets tricky. When you're ready to pull your money out, maybe for a down payment on a house, maybe to start a company, maybe it's just because you want to use your money, well, that advisor's compensation goes down. Your $100,000 becomes $60,000 and their $1,000 becomes $600. I've heard too many stories of advisors redirecting clients away from using their own money. Client is ready to pull money out of the market for a down payment, and the advisor says, now's not a good time. Or they make it complicated, or they subtly discourage it. Here's the thing. Most advisors aren't doing this maliciously. It's subconscious. When your paycheck is directly tied to keeping money in the market, you develop a bias towards keeping money in the market, even with the best intentions. So here's what we did differently. Our advisors are salaried. They don't get paid when you invest more. They don't get paid less when you pull money out to use it for your life. Their compensation is completely divorced from your account balance. What this means for you is fairly straightforward. When you're ready to use your money, your advisor's only job is to help you use it wisely, not to project their paycheck, not to hit their numbers for the quarter, just to make sure that you're making good decisions for your goals. And actually, I'm looking to take this to the next level, designing a bonus structure where advisors get rewarded when you accomplish your goals. Bought a house, paid off debt, hit that savings target you set 2 years ago. That's what I want to celebrate and compensate. Haven't rolled it out yet because I want to make sure I get it right, but that's the direction we're headed. Your wins should be our wins, period. Decision 3, you won't invest $1 until you understand why. This one probably costs us the most clients and the ability to grow quickly. Most firms will let you open an account, transfer money in, and start investing within a few days, a few hours. It's fast, it's easy, it feels productive. We won't do that. Before we invest a single dollar of your money, you're going to go through our planning process. We call it the stash plan. And yes, it takes longer. Yes, it requires more work from you up front. But here's why it matters. Investing without a strategy is really just gambling with better marketing. We need to understand your goals. We need to know your timeline. We need to make sure you understand our investment philosophy and why we do what we do. Because if you don't understand the why behind your investments, you're going to panic and make a bad decision the first time the market drops 20%. And it will drop 20%. That's not a maybe, that's a when. So we slow it down. We make sure you're educated. We make sure the strategy actually aligns with your life, your goals, not just some generic risk tolerance quiz you took on our website. The benefit for you, when the markets get volatile, and it will, you're not going to freak out and sell at the bottom. You're also not going to chase performance. You're going to stick to the plan because you actually understand the plan. Decision number 4. We've already vetted the experts you'll eventually need. Here's a scenario I see a lot. You're 35, maybe you just got married and you're thinking about buying a house, or you just had a kid. Suddenly you realize you probably need an estate planning attorney, or to understand life insurance, or you need a CPA who actually gets your situation. So what do? You ask around, you Google, you end up on some lawyer's website that looks legitimate, but who knows? It's overwhelming. And often you just don't do it because it's one more thing on the list and you don't even know where to start. We decided that shouldn't be a problem, let alone your problem. So we've curated specialists, estate planning attorneys, CPAs, insurance experts, mortgage brokers, and vetted them hard. These aren't just referral partners that we send you to and hope for the best. These are people we trust with our own families. My sister has actually used all of our experts, and actually both my sisters. And here's the part that might surprise you. We don't take kickbacks from them. In a lot of firms, when they refer you to a mortgage broker or an insurance agent or an accountant, you're getting a cut, which means they have an incentive to refer you whether it's right for you or not. We flipped that. Instead of taking the referral fee, we negotiated a discount for you. Why? Because we want you to have access to the experts you need at a fair price without having to wonder if we're sending you there because it's good for us. Your financial life touches so many areas. We wanted to make sure you had a trusted team for all of it, not just the investing part. Decision number 5, your advisor serves, they don't sell. This is another behind the scenes one. Our advisors don't prospect. They don't bring in their own clients. They don't spend any time on sales. In most firms, advisors are responsible for finding new clients. And when that's the case, Not hard to imagine, they actually focus on the highest net worth prospects. Why spend your time on someone with $50,000 when you could go after someone with $500,000? Our advisors don't do any prospecting. They just take care of you. So, why is this good for you? First, our advisors can't cherry pick the wealthy clients and phone it in for everyone else. You get the same level of care whether you have $50,000 or $500,000. Second, it removes subconscious bias. Our advisors work with people of all backgrounds and all income levels. It makes them better advisors. They have more perspective, more emotional intelligence, and more ability to relate. Third, it means we hire true service professionals, not salespeople. No shade to salespeople, but in my humble experience, those are different skill sets, different personality types, right? Think about your own firm. Would you want your salespeople executing on service or vice versa? I wanted people who are wired to help, not to close. Decision number 6, we measure success by your goals, not investment performance. Let me tell you about a popular industry tactic, portfolio analysis. Here's how it works. You upload your investment statements, the advisor runs it through software, and then they tell you everything that's wrong with it and how they would have done it better. It's a great sales tool. It makes the advisor look smart, and it makes you feel like you've been doing it wrong. And it's complete BS. Because you can't know if a portfolio is good or bad unless you know the person's goals. A 60-40 stock bond split might be perfect for someone retiring in 2 years and terrible for someone who's 30 and saving for the long term. So we don't do that. We don't lead with performance numbers. We don't gamify your investments. We don't promise sexy returns. We focus on probability of success, of achieving your goals. Given your goals, your timeline, what's the probability that this strategy gets you to where you want to go? It's less flashy, but it's the right question. And it prevents you from comparing yourself to benchmarks that don't matter, like the S&P 500, or to people whose goals are completely different from yours. So, why am I telling you all of this? I think you deserve to understand how incentives work in the financial services industry, how the way advisors get paid shapes the advice you get, and how growth tactics can conflict with what's actually best for you. When I think about Stash Wealth, I think about building something that lasts long after me. That applies to your money, yes, but it also applies to how we've built this firm. We could have grown faster. We could have made it easier, but I don't think we could have made it better. Every decision I shared today was a trade-off between growing faster and serving better. And we choose serving better every time. And at the end of the day, I believe that's what matters. All right, it's that time. Best Bite. I always end the show with a segment called Best Bite. I like to share the best thing I've eaten in the last week. So for this past week, actually, I'm recording this right after Valentine's Day. I ended up walking around the city for the day and popping into all kinds of little places. I ended up with a plum tart from St. Ambrose. It was yay big. It was a little layer of cream and then the most perfectly sliced and placed plums. And I thought it might be tart, but it was sweet and crispy. It was so delicious. It's not a Valentine's Day special. So if you're in the area, St. Ambrose, there's a couple locations. So you might be able to find one close to you. And I highly, highly recommend the plum tart. All right, that's it for today. If this resonated with you, please do me a favor. Subscribe to the show if you haven't already. And more importantly, share this episode with someone who might need it. It really helps people find the show when you're willing to share it. Maybe it's a friend who just started thinking about their finances more seriously, and maybe it's someone looking for a financial advisor. Maybe someone has been burned by a financial advisor before. These conversations matter, and I really, really appreciate you helping to spread the word. Thanks for listening. See you next time.
Thanks for listening to The F Word with Priya Malani. If you like what you heard, hit subscribe wherever you're listening and leave us a review while you're at it. We're approval junkies. Don't forget, you can find a ton of great resources, content, courses, and other freebies at stashwealth.com. Now, for the capital S stuff our lawyers want us to say. StashWealth is a registered investment advisor. Content presented is for informational and educational purposes only and is not intended to make an offer or solicitation for any specific securities, product, service, or strategy. Consult with a qualified investment advisor, that's us, before implementing any strategy. Investing involves risk, including the loss of principal. Past performance does not guarantee future results. There, we said it.
Did I have that up?